Some numbers in, and we are high, on the high side, 0.4% for both the headline and the core on a month-over-month basis. That pushes the year-over-year number from 3.2% to 3.5% for the headline. 3.5. And for the core, we go to 3.8 from 3.8, so no change there. So a disappointing result in terms of the headline numbers.
I still think the odds probably favor another rate cut this year, but not by very much, and not by as much as is priced into the markets, even after the adjustment that we have seen.
Hi Team Value, JJ here, welcome back. Well, inflation numbers have come in hot, the CPI and more inflation numbers to come, and the market reacted. Let's call it mild panic, and it went down quite quickly and instantly when the numbers came in too hot. Today we're going to have a quick look at some commentary by Larry Summers, former Treasury Secretary. He's also on the board of OpenAI. What he has to say, great deal of experience on the macro. What he thinks about inflation and interest rates. So let's get into it.
Larry, great to have you with us on short notice. We've been talking about inflation on Wall Street Week for some time now. I know you're not hoping for more inflation, but you've been warning about it. What do you make of the numbers we saw today?
I was not hugely surprised by the numbers. In an economy that's growing faster than potential, with an unemployment rate that has a 3 handle, in the presence of massive and growing budget deficits and epically easy financial conditions, the idea that inflation would remain robust or even accelerate should not be a surprise to anyone.
I'll just go ahead and say here that it's really not a surprise to me. People try and predict the rates, the direction of rates one way or the other, and inflation. There is quite a lot of people on YouTube that were predicting one way or the other, like they're going to know what's going to happen. And there's one thing that I've taken from super investors, great investors like Warren Buffett and Howard Marks and Ray Dalio and people like that, it's that you cannot really predict. You might be so sure that interest rates might go a certain way or inflation goes a certain way, and then it does the opposite. You know, in terms of probabilities, the probabilities can swap. And, you know, I don't think people should invest based on, you know, rates going down. It's looking more and more like they won't go down, maybe not even for the rest of the year. And inflation is sticky. In a recent video I made with Aswath, Damodaran, he made the point that inflation can be really sticky. Over history, it's proven to be really sticky. People were expecting inflation to come down. Michael Burry has said before that he expects a second big bounce. So there are all these opinions, but it's hard to invest based on the macro like this. We just don't know. Stanley Druckenmiller is an investor who's done that successfully based on the macro, but he can change his mind from week to week, being very agile in terms of investing. And he was expecting a recession. Are there signs of a recession? It could still happen. People were sort of saying that's not going to happen. The economy does seem to be sort of racing at the moment. So, you know, that puts the Fed in a difficult position. Let's see what else Larry Summers has to say here.
It was not me or some outside observer who emphasized the concept of supercore inflation, that is taking out the transitory stuff and also taking out housing. And by that measure, inflation is running at above a 6% rate, and the 3-month rate exceeds the 6-month rate, and the 6-month rate exceeds the 1-year rate. This confirms the idea that the neutral rate is way above the 2.6% level that the Fed has been using as a North Star. In my view, puts back on the table. It is still not what I would expect, but you have to take seriously the possibility that the next rate move will be upwards rather than downwards.
Wow, see, in terms of the stock market, so many people are thinking the opposite of that. But, you know, it just shows you what can happen if things don't go as expected, and often that they don't go as expected, you know, from week to week. And there can be black swan events that happen as well.
And anything could happen. Markets could crash, the indicators could turn down. But on current facts, a rate cut in June, it seems to me, would be a dangerous and egregious error comparable to the errors the Fed was making in the summer of 2021 when it just didn't get the thread. on inflation.
Well, it looks like that could be not in the cards, a rate cut. It could go the opposite way even. Imagine if it did the opposite, what's going to happen to the stock market? It's very hard to predict these things. As I keep saying, so many people who have expected it to rates to go down. There was one talk of 3 rate cuts throughout this year, and it's being pushed further and further back based on what's happening quarter to quarter. Now, if you're getting value out of this video so far, please remember to hit that like button if you're watching on YouTube or anywhere else with a like button. Appreciate that. It helps the algorithm to spread it to more people.
Larry, you mentioned the supercore that, as I recall, Chair Jay Powell, among others, has talked about specifically. It raises the issue of, are there aberrations you see in these data? We hear some people saying, wait a second, this is really housing and auto insurance. There are a couple of outliers, and that the rest isn't as troublesome. Is that right?
I don't think so. Look, you can always find particular indicators that are up or down, but when you're making up a story month after month, that's a problem.
Yeah, people are pointing to these particular indicators saying it's just this, it's just housing, or it's just insurance, or it's just autos, and once those are ironed out, it'll be fine. But as he's saying, things change month to month. Every time there seems to be something, and inflation is proving to be really sticky. There's more inflation data to come out soon too, PPI, Producer Price Index, as opposed to Consumer Price Index. So it'll be interesting to see what happens to the market.
When commodity prices are spiking and those are being taken as a market indicator of inflation expectations, when break-evens have risen, when the political economy of the country is heavily about inflation, trying to dismiss it on an indicator by indicator basis is an odd thing to do. Look, it is a technical subject, the price indices for housing. I don't think there are many Americans who feel like housing is becoming lots more affordable these days.
I've heard that too, just from anecdotally from listening to different podcasts. People are not saying that, they're saying the opposite. They're surprised that it's still keeping going, that that there is appetite there to push prices up.
And so to argue that somehow housing isn't a source of inflation psychology seems to me to be quite a surprising view to take. Look, why are we thinking about rate cuts when the economy is below what the Fed thinks is the normal unemployment rate, when the economy is growing faster than what the Fed thinks is potential, and when inflation is unambiguously above target and plausibly accelerating? The Fed has once again, in important respects, lost its way over the last 6 or 9 months in the same way, making policy and making forecasts based on hope rather than on a hard-headed look at reality.
Well, he's being very critical there of the Fed. And in terms of market psychology, what he was saying there, as I said, the market's expecting rate cuts. It could be, this could flip. What will happen to stocks there? The stock market is always fascinating like this based on the macro. People have these expectations. A lot of traders have expectations and definitely trade on that, expecting these rate cuts, and then now they're being pushed out and they may not happen at all.
I think that the Fed did a good job of cleaning up on the errors they had made in 2021. And I think it's reasonable to think that they will pivot off the errors they made last fall that led markets to be ludicrously expecting 6 cuts this year. And I'm hopeful that that will happen.
The markets did kind of launch when there was this talk of expecting 3 to 6 rate cuts this year, and it's definitely changing from then.
But I think the Fed does need to learn some important lessons from this experience. We need a Fed that stays focused on what is very clearly the focus of the American people, which is price stability. And I'm afraid there are some signs that in the last few months, they have lost their focus in favor of more ambitious economic theories about preempting slack that's not happening or some such.
Larry, you're always the first to warn us that things can change. So we can't predict what's going to happen in the fall and into next year. You've said you think it's definitely a mistake for the Fed to cut in June. But given where we are right now, what you know right now, if you had to make a decision, are we going to see any cuts this year? And what is the likelihood of actually an increase?
I said on current facts, I see no case for a cut in June. But facts can change. Inflation indicators could come in much lower than most of us are expecting. The economy could turn down. So never make an absolute judgment about policy several months from now, because all kinds of surprises could happen.
Yep, and that's the danger of predicting too far ahead what's going to happen with stocks, and thinking even a few months ahead, anything can happen.
I think the odds are that the next rate cut will be down rather than up. But I think you have to assign a greater probability to the next rate cut, rate move being up than you did several months ago. I don't know whether it's 15% or it's 25%, but somewhere in that range is what I would say for the next rate cut, rate being up.
I like how he's talking about probabilities here, the probabilities changing rather than absolutes. So many people try and predict absolutely what's going to happen.
I still think the odds probably favor another rate cut this year, but not by very much, and not by as much as is priced into the markets, even after the adjustment that we have seen. So reality, markets are adjusting to reality. The Fed is adjusting to reality.
And again, Aswath Damodaran, just in that last video that I made just a day ago, talking that he thinks that the markets are overpriced, then they're not pricing in the probability that he's talking about here, and that's started to happen today. Will it continue? We'll have to see.
But I think the process is slower than would be ideal.
I think we'll leave the inflation and interest rates talks there, but I'd love to know what you think. Do you think the next interest rate move is going to be up or down, and when will that be? Now, it's fun to predict, it's fun to talk about these macro issues, interest rates, but I certainly wouldn't invest based on specific moves, specific predictions. Do you think that inflation will keep going up? Will they get it under control? Do you think they'll get it down to under 3? It's not looking like that at the moment. It's looking very sticky. And do you think there'll be a recession? It's being held off, but do you think that it still might happen? Let me know in the comments. Now, if you're not aware of what's going on over at the Art of Value Patreon, I'll put a link in the description to that over there. There's exclusive content, a growing amount of exclusive content. There's also something for free members over there too. You can just join for free if you want to and decide later if you want to move up a tier. Now you can watch videos ad-free and usually early access as well, even for free members. Again, link in the description, and I'll see you over there. Now, if you're watching this video on YouTube, I'm going to put a link here to what YouTube thinks that you in particular should watch next. So go and see that now if you want to. And thanks to everybody for watching or listening, and I'll see you in the next one.